Ever felt that, that sting when you look at your payslip and a big chunk of your hard-earned money just vanishes in tax? Especially if you're a higher rate taxpayer in the UK. Seeing 40%, maybe 45%, or even more disappear, well, it can be pretty disheartening, can it? Even when, you're doing well.
It's a common frustration, definitely.
But what if there were ways, like legitimate UK government schemes, hiding almost in plain sight, designed to actually help you keep more of that money and use it to build wealth faster?
Well, that's exactly what we're diving into today.
Yes. Welcome to the deep dive. Today we're unpacking some really powerful tools, not just small tweaks. These are, well, fundamental for potentially transforming your financial future.
Precisely. And our guide for this journey as part of the Plouta team is actually Plouta's own fantastic resource. Our deep dive is based entirely on their guide, UK Tax-Efficient Investments for Higher Rate Taxpayers. It lays out these sometimes complex strategies really clearly.
Yeah, it's a great guide. And Plouta's mission, it says it right there in the guide, is to empower individuals with clear, trustworthy financial insights that help them achieve true financial freedom. And that's pretty much what we're aiming for with you today, too. We'll pull out the key bits, the most important takeaways, acting like your shortcut to getting properly informed about these honestly crucial tools. They're key for accelerating wealth and planning long-term.
Absolutely. But before we jump into the specifics, we have to make something crystal clear. It's really important.
Okay.
As the guide itself stresses, what we're discussing here is general information about UK tax-efficient investments. It's for informational purposes only. It is not financial or tax advice.
Right. Very important distinction.
Schemes like VCTs, EIS, SEIS, AIM-ISAs, these are high-risk investments. They aren't suitable for everyone. You could potentially lose all the capital you invest.
Okay.
And remember, the value of any investment can go down as well as up. Also, tax rules, treatments, allowances, they depend on your individual circumstances, and crucially, they can change.
Good point.
So always seek professional, regulated financial advice that's tailored specifically to you before making any investment decisions. This deep dive, it's purely to help you understand the content of Plouta's guide.
Okay, vital disclaimer delivered. Thanks for that. Right then, let's get started. Think of your financial strategy, maybe like building a house. The Plouta guide makes it really clear that before you think about adding, the fancy conservatory or the loft conversion, you need solid foundations.
Absolutely. Non-negotiable.
And for higher rate taxpayers, there are two foundational pillars that you have to get right first.
That's right. The first one, and arguably one of the most powerful tools available, is the self-invested personal pension, the SIPP.
SIPP, right.
SIPP is basically a type of personal pension where you have control. You get a really wide choice of investments you can hold within it, which is, a big plus for tailoring your growth potential.
And this is where it gets really interesting for higher rate folks, isn't it? The tax benefit. It's kind of unbeatable.
It really is.
So when you put money into your SIPP, the government automatically adds 20% basic rate tax relief. That just happens.
Yeah, the top up.
But if you're paying 40% tax or even the 45% additional rate, you can then claim back another 20% or 25% through your self-assessment tax return.
That's the key extra step.
That's that yearly form you send to HMRC, right? Where you declare income and claim reliefs.
Exactly. So you get the immediate boost, and then you claim the rest back directly.
Let's use that example from the guide because it really makes it clear. Say you put £10,000 into your SIPP.
Okay.
If you're a 40% taxpayer, that £10,000 contribution effectively only costs you £6,000 from your own pocket.
How does that work?
Well, you pay in £8,000. The government adds £2,000 automatically. That gets you to £10,000 in the pot. Then you claim another £2,000 back via self-assessment. So net cost, $6,000.
Right.
And if you're a 45% taxpayer, even better. The net cost drops to just £5,500 for that same £10,000 going into your pension.
It's like getting an immediate return before your investments even start doing anything. It's quite remarkable.
Exactly. And it doesn't stop there, does it?
No, absolutely not. Beyond that initial uplift, all the investments inside your SIPP grow free from capital gains tax and free from UK income tax, too.
Wow.
Plus, and this is a big one for longer-term planning, pensions are typically outside your state for inheritance tax purposes.
So lots of benefits packed in there. Who's it really for then?
The guide is very clear. Every higher rate taxpayer should be looking at this. The general advice is aim to contribute as much as you can up to your annual allowance. That's currently £60,000 a year.
$60,000, that's quite generous.
It is, although it can be tapered, meaning reduced, for very high earners. So if your income goes above certain levels, that 60-pound allowance might shrink. Something to be aware of.
Okay, so SIPPs are the powerhouse for retirement savings, long-term wealth building. Got it. But what about money you might need, before you retire or for other goals?
Good question. That brings us perfectly to the second foundational pillar, equally vital, the individual savings account, the ISA.
Right, ISAs. Everyone's heard of ISS.
Yeah, but their power is sometimes underestimated, especially alongside pensions. Unlike a pension, ISAs don't give you that upfront tax relief when you put money in.
Okay.
But their genius, their key benefit, is that all the growth is entirely tax-free. And crucially, when you take money out, that's tax-free too.
So complete flexibility on the way out.
Exactly. Which makes them the perfect partner to a pension. Flexibility now, tax relief later with the pension. An ISS is basically a tax wrapper, letting you invest up to £20,000 each tax year. That's the limit for 2025-26.
And for a higher rate taxpayer, those tax-free benefits inside the ISA are, well, they're huge.
They really are.
Think about it. All the growth, completely free from capital gains tax. Doesn't matter how much your investments make. And all the income dividends from shares, interest from bonds or cash, completely free from UK income tax.
Which is significant when you remember a higher rate taxpayer could be paying, nearly 40% tax on dividends.
Up to 39.35%, yeah. Or 40% tax on interest once you're over your, frankly, quite small £500 personal savings allowance.
Right. So the ISA shields all that income and growth.
So who's this one for?
Again, the guide says every higher rate taxpayer. It's positioned as the main way to build up a pot of money that's flexible, accessible before retirement, and completely tax-free for all sorts of life goals.
Makes sense. A foundation of SIPP for the long term, ISA for flexibility.
Precisely. The guide's fact sheet does briefly mention other types, like the lifetime ISA or LISA. That gives a 25% government bonus, but it's mainly for first-time buyers or retirement savings under specific rules.
Okay.
But the main focus, the core message, is really on that general stocks and shares ISA as the go-to vehicle for flexible, tax-free money.
Right. So build that solid foundation first, max out those SIPP and ISA allowances as much as your circumstances allow.
Absolutely. That's the bedrock.
Okay, then. And the guide is really clear. It's only after you've done that.
Yeah.
Then you can start looking at, let's say, the more adventurous stuff. For investors who understand and are comfortable with higher risk, there are these things called venture capital schemes. They offer really quite substantial tax reliefs designed to encourage investment into smaller, unlisted UK companies, startups, and growth businesses.
Definitely not for everyone, these ones. But for the right person, the tax benefits can be very significant indeed.
So what's the first one?
The first of these advanced strategies is venture capital trusts, or VCTs.
Okay, VCTs.
Now, what's interesting here is you're not investing directly into one single startup. A VCT is actually a publicly listed investment company itself. You buy shares in the VCT, and it then invests in a portfolio of young entrepreneurial UK businesses. So you get a bit of diversification within that high-risk space.
Right, spreading the risk a bit compared to backing just one horse. And the tax benefits.
Compelling. You get 30% upfront income tax relief on whatever you invest, up to £200,000 per tax year.
30% back on your income tax bill.
Straight off. So invest £10,000, and you could potentially reduce your income tax by £3,000 that year.
Wow. Is there a catch?
Well, the main condition is you have to hold on to those VCT shares for at least 5 years to keep that initial tax relief.
Okay, 5-year minimum hold. What else?
It doesn't stop there. Any dividends the VCT pays out while you hold the shares, completely tax-free.
Nice.
And when you eventually sell the VCT shares, assuming you've held them for 5 years, there's no capital gains tax to pay on any profit either.
Okay, so upfront relief, tax-free dividends, tax-free growth. Sounds good, but who is this really suitable for?
Given those features and the risks involved, VCTs are generally targeted at higher earners who have a significant income tax liability they want to reduce.
Right.
They need to be comfortable with, frankly, very high investment risk, and they must be prepared for that 5-year minimum commitment. Longer, ideally.
And the risk level, you said, very high.
Very high, yes. The underlying companies are small, often unproven, and VCT shares themselves can be illiquid.
Meaning hard to sell.
Exactly. You might not be able to sell them quickly. If you need your money back urgently, there isn't always a ready buyer.
Okay, VCTs. Got it. What's next in this high-risk category?
Next up is the Enterprise Investment Scheme, or EIS.
Oh, EIS, right.
Now, EIS definitely takes the risk level up another notch, because unlike a VCT where you buy into a portfolio,
Yes.
with EIS, you're investing directly into the shares of a single, qualifying, small, unlisted UK company.
Ah, okay. So you're picking the individual company yourself, or through a fund manager, perhaps, but it's direct shares in that company.
Precisely. Direct exposure. Higher potential reward if it does well, but obviously much higher, more concentrated risk if it doesn't.
And the tax benefits for taking on that extra risk.
They are also incredibly generous. You get 30% upfront income tax relief, just like VCTs.
Okay.
But the investment limit is much higher, up to £1 million per tax year normally, or even £2 million a year if you invest in what they call knowledge-intensive companies, typically R&D-focused businesses.
£1 or £2 million you can invest and get 30% tax relief on.
Potentially, yes. And the holding period here is shorter than VCTs, just 3 years to keep the relief.
3 years. Okay. What else?
On top of that upfront relief, if you hold the shares for those 3 years, any profit you make when you sell them is free from capital gains tax.
CGT-free growth. Nice.
And there's another really powerful feature called capital gains deferral.
Deferral. What's that?
Let's say you sold something else, maybe shares or property, and made a capital gain you'd normally have to pay tax on.
Right.
If you reinvest that gain into EIS qualifying shares, you can defer paying the tax on that original gain. You essentially push the tax bill down the road until you sell the EIS shares. It's a way to manage tax on past profits.
Huh. That's quite clever. But what if the EIS company? Oh, what if it fails? That must happen quite often with startups.
It does, and that's where another crucial feature of EIS comes in, loss relief. This is really important.
Loss relief.
Yes, if the company you invested in unfortunately goes bust and your shares become worthless, you can offset that loss against your income tax bill for that year or the previous year. The amount you can offset is your initial investment minus any upfront income tax relief you already claimed.
So even if the investment goes completely wrong, you can get some of it back by reducing your income tax.
Exactly. It acts like a significant cushion against the downside risk. It doesn't eliminate the risk of loss, but it softens the blow considerably.
Okay, that makes the high risks slightly more palatable, I suppose. So who is EIS typically for?
It's really for sophisticated investors. People with a genuinely high appetite for risk, who perhaps want to actively back individual startup companies they believe in, and who can really make use of those powerful tax reliefs, including the loss relief.
And the risk level here, even higher than VCTs.
Extremely high, yes, because you're concentrating your investment in single, very early stage companies. The chance of failure and total loss of capital is significant. No getting around that.
Right. Extremely high risk. Okay, is there anything even riskier?
Believe it or not, yes. At the very, very top end of the risk-reward spectrum for these venture schemes, we have the Seed Enterprise Investment Scheme, SEIS.
Seed EIS. Okay, the name suggests even earlier stage.
That's exactly right. SEIS focuses squarely on brand new seed stage companies. Think really, really early, often just starting out, maybe pre-revenue.
Wow. So maximum risk here, presumably.
Maximum risk, yes. You're investing directly into the shares of these tiny, very new startups. This is where innovation often sparks, but it's also where the failure rate is highest.
So why would anyone do it? The tax breaks must be incredible.
They are even more generous than EIS, which is saying something. With SEIS, you get a massive 50% upfront income tax relief.
50%, half your investment back as income tax relief.
Up to an investment limit of £200,000 per tax year. So invest £10,000, potentially get £5,000 off your income tax bill.
That's huge.
It is. Plus, you get all the other benefits similar to EIS. Capital gains, tax-free growth if held for 3 years, potential loss relief if the company fails. And there's even a unique SES feature called SES reinvestment relief. If you've made a capital gain elsewhere, reinvesting it into a SES company can actually cut that capital gain in half, tax-wise.
Okay, this sounds like supercharged EIS, but for even earlier companies.
That's a good way to think about it, which really tells you who SES is for.
Ooh.
It's only for the most experienced, high net worth investors. People who are genuinely comfortable with the extreme risk involved in seed stage investing, understand the high likelihood of failures, but are attracted by those incredibly powerful tax incentives.
And the risk level, just to be absolutely clear.
Extremely high, probably the highest of the mainstream tax-efficient schemes. Many seed stage companies simply don't survive. You have to go in expecting losses on some investments.
Understood. Okay, so that covers the main venture capital schemes.
Yep.
VCT, EIS, SES. High risk, high potential relief. Now, the guide also mentions some other more specialist options.
It does. These are for people with perhaps very specific needs, or maybe those who've already maxed out their pensions and ISAs and are looking for other niche opportunities.
Right.
One is the AIM ISA.
AIM, ASA. What's AIM?
AIM stands for the Alternative Investment Market. It's the London Stock Exchange's market for smaller, growing companies. So an AIM ISA is a type of stocks and shares ISA, but it invests only in the shares of companies listed on AIM.
Okay, so it's an ISA but restricted to smaller companies. What's the special tax angle?
Well, it combines the usual ISA benefits tax-free growth, tax-free income, with a potential inheritance tax advantage.
Inheritance tax, how does that work?
Many, although importantly not all, shares listed on AIM can qualify for something called business property relief, or BPR.
BQR, okay.
If shares qualify for BPR and you've held them for at least 2 years at the time of your death, they can potentially be passed on completely free of inheritance tax. They fall outside your state for IHT calculation.
Ah, I see. So it's an ISA wrapper, but potentially with an IHT benefit built in down the line.
Potentially, yes. That's the attraction. So who's it for? Generally, investors with a higher tolerance for risk, because AIM shares are smaller company shares, they tend to be more volatile.
Right.
And people who are looking for long-term growth combined with potential IHT planning. Usually this is considered after using up mainstream ISA and pension allowances.
And the risk level for AIM ISAs? High.
High, yes, definitely higher than investing in larger mainstream companies. AIM is inherently more volatile.
Okay. AIM ISA for growth and potential IHT planning. High risk. What else is specialist?
The final one we'll touch on from the guide is small self-administered schemes, or SSAS.
SAS. Sounds like another pension.
It is. It's a specialist type of occupational pension scheme, usually set up by a limited company, typically for its directors.
Occupational, so linked to the company.
Yes.
Yeah.
Usually small, up to 11 members, typically just the directors. The key thing is the members themselves are the trustees. They have significant control over the scheme's investments.
So more control than even a SIPP.
In some ways, yes, especially regarding interactions with the sponsoring company. Tax-wise, a PESAS gets all the usual SIPP benefits, tax relief on contributions, tax-free growth.
Okay.
But it has some unique powers. A SAS can, under strict rules, actually loan money back to the sponsoring limited company.
Loan money from the pension to the business.
Yes. Or, perhaps more commonly, a SAS can purchase the company's own commercial property, like its office or factory.
By the building the business operates from.
Exactly. The business then pays rent directly into the SAS, into the director's pensions. That rent is received tax-free by the pension scheme,
Right.
and it's usually a tax-deductible expense for the company paying it. It creates this sort of tax-efficient circular flow of cash.
That sounds quite specific. Who uses these?
It's pretty much exclusively for directors of profitable, established, limited companies, people who have significant pension funds already and want this very specific ability to integrate their pension with their business assets, like property or through loans.
Then the risks.
Again, but in a different way. SSAs often lead to poor diversification. Imagine if the pension's only real asset is the company's building.
Yeah, all eggs in one basket.
Exactly. And if the business struggles, the pension is directly impacted. They are also complex schemes, expensive to set up and run correctly, with lots of regulations to follow. Definitely specialist territory.
Understood. Complex, specific benefits, high risk. Okay. Anything else mentioned?
Just a quick note, the guide includes on social investment tax relief, SITR.
SITR.
Yeah, this used to give 30% income tax relief for investing in social enterprises. But the key thing is it closed to new investments back on April 6th, 2023.
So you can't use it anymore.
Not for new money, no. But if you invested before that date, you still need to hold the investment for 3 years from when you made it to keep the tax relief you claimed. So it's just in there for completeness, really, for people with existing holdings.
Got it. Historical context. Okay, phew. We've covered a lot of ground there, from the foundations to the really quite complex stuff.
We certainly have.
So let's try and pull this all together. What's the big picture here for a higher rate taxpayer listening to this? What's the core message from the Plouta Guide?
I think the core message is about strategic layering. It's about building your tax-efficient strategy step by step in the right order.
Layering. I like that.
And the absolutely non-negotiable first layer, the foundation we kept coming back to, maximize your pension contributions and your ISA contributions every single year as much as you reasonably can.
Right. SIPP and ISA first. Always.
They offer for most people the best blend of powerful tax benefits, simplicity, and flexibility. That's where the bulk of wealth accumulation should probably happen for most higher rate taxpayers. Build that solid base.
And it's really important, isn't it, to stress the sequence. The guide implies you should only really look at things like VCTs, EIS, SEIS, after you've fully used your pension and ISL allowances.
Absolutely. Only once those foundations are secure, then sophisticated investors, people who genuinely understand and are comfortable with significant risk. Then they might consider layering on those venture capital schemes to get that extra income tax relief. They are an addition, not the starting point.
And the specialist options, like SEIS or SS.
They fit in for people with very specific circumstances later on. Maybe advanced inheritance tax planning for SEIS or that niche business integration for SS. Again, not typically the first place you'd look.
So the overall point is, if you layer these strategies correctly using these government-approved schemes, well, you can potentially reduce your tax bill quite significantly.
Definitely. And allow your capital, your money, to work much, much harder for you towards achieving whatever your financial goals are. It's about empowering your savings and investments.
Okay, so we've taken a real journey today through this landscape of tax-efficient investments for UK higher-rate taxpayers. From those essential foundations like pensions and ISAs, right through to the advanced high-risk venture capital schemes and specialist options, we really hope this deep dive, using the insights from Plouta's comprehensive guide, has maybe given you some surprising facts, or at least some clearer pathways to consider.
So what does this all really mean for you listening right now?
Well, I think it means that getting your head around these government-backed schemes isn't just about, saving a bit of tax here and there.
Yeah.
No, it's about proactively taking control of your own financial journey. It's about potentially accelerating your path towards what Plouta calls true financial freedom. If, and it's a big if, these strategies are applied correctly for your situation, and always with professional guidance. It's about making your wealth work as smartly and as hard as you do.
That's a great final thought. But let's end with that crucial reminder one last time. It's so important.
Please do.
As we've stressed throughout this deep dive, based on Plouta's guide, your personal financial situation is absolutely unique. Always seek professional, regulated financial advice tailored specifically to you before making any investment decisions.
Couldn't agree more. Remember, the value of investments can fall as well as rise. And with some of the schemes we discussed, particularly VCT, EIS, SES, you could lose all your capital.
Essential reminders.
We really encourage you to continue this conversation. Please do join our financial wellness community. Like this deep dive if you found it useful, share it with others who might benefit, and of course subscribe so you don't miss future explorations.
Yeah, we'd love to hear from you too.
Absolutely. Drop your comments below. What did you think about the concepts we reviewed from Plouta's guide today? Did anything stand out? Anything surprise you? Let us know. We look forward to diving deeper with you again next time.